in gallery.
Welcome, everybody. I'm Dan Mogelson with the St. Paul Jewish Federation. We're glad you could join us for the Planned Giving Salon, The How. And we're excited to have wonderful speakers today talking about the mechanics and also some inspiration of why we're doing this. Wanted to just open up with a few quick comments. One is that we're recording the session. Two, just to please mute yourself until we have the open Q&A at the end of the session, and then feel free to use the chat feature. We will have Q&A at the end, and we'll be watching to see what comments come through. So I'm going to hand this over to Don and Rhoda, who are going to begin this session.
Wow. Oh, there I am. Okay. Thank you very much. And needless to say, I think everybody here knows both of us. It's really good to see that there is this kind of interest. I think more than what we're even seeing here in tonight's topic on planned giving. It's a topic that Don and I feel very strongly about. We love this community. We've been involved for longer than most of you have been alive. And we need to assure that there's support going on into the future. We don't know what the future will bring, what federations will be like, what Jewish communities will be like, but we want to provide the assurance that this wonderful community will still be here and able to provide for whatever may come up in the future. So we do have a full agenda tonight. Don?
Yeah, just a few words. I want to second everything Rhoda has said. I want to thank you all for being here. Planned giving is so important. And I especially want to thank and welcome Stuart Bear, Ron Matz, and Andrew Seller. They're going to give you some valuable information. So I'll turn it over to Ron on planned giving, the how.
Don, thanks very much. Rhoda, thank you. It's really a pleasure to be here this evening with everyone here. I personally have long been fascinated with the mitzvah of tzedakah, and perhaps it dates back to one of my first jobs when I got to Minnesota over 40 years ago, that of a professional fundraiser for the American Heart Association. And when my fundraising career soon morphed into working with Jewish organizations like Torah Academy and Israel Bonds, I particularly found of interest the difference between giving in the Christian community and that of the Jewish community. I don't know if we all know this, but there's actually no word for charity in the Hebrew language. I found that fascinating from the start, and where charity is actually derived from the Latin word charis, which translates into an act of kindness or benevolence, while tzedakah, the next closest word in the Hebrew language, as many of you know, means something quite different, that of justice. So Jews give, or should give, not necessarily out of the goodness of their heart, but because it's the right thing to do. There can be no better examples in our community, in my mind, of carrying out this type of action on a day-to-day basis than that of our guests of honor, Rhoda and Don Maines. Truly, they represent the actions of righteous people, neither seeking praise or gratitude, but serving as true examples in our community of tzaddikim, righteous people. Don and Rhoda embrace this opportunity and the obligation to assist God in repairing the world fractured by economic strife and disparity. They have served as role models to me, as to many others in our community, and I'm so proud to help honor them with this recognition that they so justly deserve. Tzedakah is so highly regarded by Jews that this emphasis is cited in the Gemara, the Talmud, in Tractate Baba Basra by Rav Asi. He teaches that to give tzedakah is equivalent to all other mitzvot in the Torah combined. For me, I'm certainly not the brightest Torah scholar, but I regard this mitzvah as low-hanging fruit. If I can pay attention to this one mitzvah, as many of you do, if nothing else, I may have a head start in my quest to live a more purposeful life. And isn't that what we all want anyway? So permit me and my colleague at Baird, Andrew Seiler, to give you a couple of tax-saving ways you might consider to give some money away. Let's start with something that I've used personally, and I think holds a fair amount of regard in our community, and that is that of donor-advised funds. This is nothing more than a tzedakah account where you can give either cash or appreciated stock or restricted stock or even cryptocurrencies. Donor advised funds also can be used as a strategy for your planned giving or legacy giving, which we'll be talking more about extensively this evening. Donor advised funds work particularly well when your income is a bit irregular. And if you wish to batch your donations in a particular year and distribute them evenly to the charities of your choice over the next couple of years, so you can take the deduction in one year and then you're making the gift to the donor advised fund, offsetting your income in a good year, and then take your standard deduction in subsequent years. These donor advised funds are certainly easy to set up. I've done it personally with the Federation, but you don't necessarily have to go to the Federation to set these up. You can do it at your Vanguard or Fidelity or what have you. We'll have time for you to ask questions and answers, but one of the things I found particularly helpful when working with my own estate planning attorney was actually using them as a vehicle for family giving. So really having family meetings, if you will, to bring the kids involved into the giving aspect by allowing them to choose the charity of their choice and maybe use some of the money that you've batched into the donor advised fund to help get them on the path for giving in the future. And this has been particularly meaningful for our family along Thanksgiving time. But be that as it may, I offer this up as a great way for you to consider really being more planful in your giving, and that's really what we want to talk about here in this evening. I'd like to turn it over to Andrew Seiler to talk about one other aspect that we use effectively at Baird, that is charitable distributions through an IRA, an individual retirement account. Andrew, go ahead.
Sure. So I see some familiar faces, but some of you might not know me. I'm Andrew Seiler. I work with Ron Matz. Bonnie and Alan are my in-laws, as well as South is my grandmother-in-law. I'm married to Talia Milovitz. So I was fortunate enough to marry into a great family. But be that as it may, my job here today is to talk about qualified charitable distributions, also known as QCDs. And essentially what a qualified charitable distribution is it's a distribution directly from an IRA to a charity. So you're not taking receipt of the funds, they're not going into your bank account. It's directly from the IRA to the charity. And by doing that, there could be significant tax savings to you. So what a lot of people do that don't know about QCDs are they take their distribution for the year, they pay their ordinary income tax on it, and then from that, whatever's left over, they'll make a small donation. But if you donate directly from your IRA to the charity, you don't have to pay any federal or state income taxes on that donation. So there could be significant tax savings if you're in a high income tax bracket, especially in Minnesota. It could be up to 45, 40, in the mid to high 40s in taxes that you can avoid on that distribution. A couple caveats to that is that you have to be 70 and a half or older to qualify to make a QCD. you can only make $100,000 worth of QCDs per year. If you're married, then the husband can do 100K from his IRA, then the wife can do 100 from her IRA. And one awesome thing is that it can count towards, it counts as your RMDs. So, the government forces you to take a certain amount out every year once you turn 72. So if they're forcing you to take $100,000 out for the year, maybe you want to donate 20,000 of that to charity. 20 of that 100 can go directly to the charity. You don't pay any taxes on that, and you still do have to take out the other 80, and you have to pay ordinary income tax on that, but it still could be a significant savings on that additional 20,000. So that's a little bit about QCDs. And Ron, do you want to talk a little bit about just donating long-term appreciated stock?
I think you're muted, Ron.
Sorry. Yep. I just found that out. Yes. Technology and I are never are compatible. But in any case, certainly appreciated stock is one of the vehicles that you can make gifts either to a donor advised fund or directly to the individual charity of your choice. The prerequisite is that actually you need to hold the stock for a year before you can make that distribution. But once it's held for a year and you make it either to the donor advised fund or the charity directly of your choice, then you're saving the, when it's done in your taxable account, then you're saving the capital gains that you would normally have to pay for it, as well as being able to get the full deduction by making the gift at that time. So, for example, if you're purchasing Microsoft at $100 and you decide that you want to gift it a year later and it's up to $250 a share, that full $150 share difference, that capital gain that you would normally have to pay tax on, top tax brackets 20%, but still that's, if you're paying 20% taxes on that $150, you're saving $30 of taxes on per share on that, as well as then getting the full $250 deduction along those lines as well. So I encourage my own clients really, whenever possible, to certainly gift appreciated stock when they can. And certainly then also you can make these gifts from your IRA as well, as you said, to avoid having to pay any of the ordinary income tax that you would normally have to pay when you're taking the money out of the IRA. So.
I think we're going to throw it over to Stuart to talk about some funding strategies.
Oh, great. Well, great. Well, I'm an estate planning lawyer, and so I'm going to be focusing on providing charitable gifts through a will or a trust or a beneficiary designation forms. I'll talk about the elephant in the room, which is an important elephant. My clients come in to see me and they say, yeah, I'd really like to give away a gift, but I'm not rich enough for that. I'm just a regular middle-class kind of person, right? By the way, I'm going to retire the day that somebody says, I'm the most wealthiest person in the world. and I want the most complex estate plan that you can think of. Everybody wants a simple will, right? So it's a real concern. So maybe let me try to put some parameters around that, maybe some suggestions for you to think about your charitable giving if you are of a mind, but you want to make sure that you provide for your family members or other beneficiaries first and foremost, and then charitable gifts. Well, I would tell clients to start out with a small specific gift. It's just a thought. Just the action of writing that in your will or your trust, or we'll talk about changing a beneficiary form in a moment, just that action is a statement. It's a clear statement that you see the world a little bit bigger than your own family and friendship circle, that you're providing for others who you may not even know, but in others in future generations, in the Jewish community, in other secular charities as well. And it's a statement. I'll tell you this, I'm old. I've been practicing nearly 40 years. And when I've seen generational gifts, for example, grandma and grandpa set up a charitable gift and it was given at their death. The story gets morphed from the children to the grandchildren, and it has nothing to do with the value of the gift, nothing at all. Children and grandchildren don't necessarily remember the value of the gift. They remember the action that grandma and grandpa gave a gift. That is a defining value for that family, that grandma and grandpa saw the world a little bit larger than just their own self. So I would commend people who are on the fence about giving or not giving to maybe consider a little gift. Now, I don't know when a person's going to pass away. I don't know the size of their estate. My clients are concerned about that. I would love to give a gift now, but write it in my will, that is. I'd like to do that now, but I don't know how much money I'm going to have left when I pass away. So there's two data points that I try to hold in my mind to suggest to my clients. And of course, it depends on the audience. But I think with this audience, I can suggest, I hope you live like Moses. I hope you live to 120. And I hope you have excellent health insurance. That's a data point. That is a point that what we do in the year 2022 is just academic, because hopefully you'll have a long, happy life with much pleasure from your family and friends, much satisfaction, joy in life, and you'll live a long life. But the reality, the space where estate planning lawyers really focus on is 3 to 5 years. That's our shelf life, as it were. It's not to say that everything has to be thrown away, but I'd recommend you seek out your attorney every 3 to 5 years and just review your documents. I guarantee you that as the years go on, your planning might change. An organization that you thought to be important is maybe of lesser important, or you've added additional charitable organizations to that as well. So I would commend you to look at it every 3 to 5 years. I know that when I mention that to my clients, usually by the 3rd year, they start to think about updating their estate plan, but because they've procrastinated, we're now at the 5th year, and then they usually go ahead and review their estate plan. So keep that data point in mind. In terms of the gifts, I mentioned a small gift, a specific gift. I want to talk a little bit about a percentage gift, because in our information age in 2022, I'm finding that a lot of my clients are reluctant to give a percentage gift. And this actually is a story from, I don't know, over 30 years ago. I was on the Beth Jacob board, and it was about 1990, and I was a new member of the board. And the board was getting information about a charitable gift that somebody had left the synagogue, which was lovely. But with that gift, it was a percentage gift. It was a percentage of the assets in the estate. With that gift, information was shared, whether properly or not, but information was shared about the entire person's estate so that the gift could be calculated and that the recipient of the gift could see how the gift was calculated. Minnesota law says that when you give a percentage gift to a charity, the charity has the right, indeed, it's really an obligation of the person who is charged with settling the estate, what we call the personal representative in Minnesota, or the trustee under a trust, to provide that information. So I think in the age of confidentiality, considering a percentage gift may turn out to be an unintended breach of confidentiality. And that certainly is a real concern. I know my clients are thinking, well, if my estate fluctuates, it's here, but then it drops to here, at least I'm providing something to the charitable organization. So something that has developed differently is a tiered approach. And remember, we live in the year 2022. If you go back to your lawyer and say, I want to talk to you further about a tiered approach, it's not going to take much more to draft that. In fact, I've long put away my quill pen and inkwell. And now drafting really is hitting this button on the computer or that button on the computer. But my clients tend to like the tiered approach because we focus on the first tier of beneficiaries. And in my example, and by the way, you're going to be shared this material. We're going to post the material for the outline that we're speaking on after our talk tonight. But the first level is maybe to provide for special beneficiaries, children, grandchildren, special friends, and a specific dollar amount is provided to those individuals. So if they're going to receive assets here and the size of the estate fluctuates, then we know that we built in the ability to take care, first and foremost, our first tier beneficiaries. The second tier might be charities, and it might be a specific gift, a specific dollar amount, which provides the level of confidentiality we're looking for, or it might be a gift to a donor advised fund. Those are not mutually exclusive, that you can, as Ron mentioned, provide a charitable gift to a donor advised fund, which allows family members to make grants from time to time and really promotes the family value of charitable giving from generation to generation. The modeling of that, right? Grandparents set up a donor advised fund and left assets to that fund. The children make the grants from that fund. The grandchildren see themselves as someday making grants from that fund as well. And that really sows in the value of charitable giving generationally down the generations. And then, so the second tier would be the charities. And then the third tier, we would address what happens with the remaining assets. In other words, if X goes to the children and then Y goes to the charities, what happens with the remaining assets? And that's something my clients would work through the issues and figure that out. That has proved to be a good strategy for clients in really thinking about things differently, thinking about not just providing their entire estate to specific special beneficiaries like children or grandchildren, but carving out a set amount to go on to charitable beneficiaries. I think I'm up next as well, and I think we want to talk about some funding strategies from the simple to the complex. Is that right? Ron, Andrew, and Dan? Great. Great, wonderful. What I like to do to get people started in charitable giving, and I know that it's sometimes off-putting, it's like, I have to go to my lawyer and she's going to charge me a lot of money and I really don't want to do this, and on and on and on. One simple thing that somebody can do just to wade in the water is to consider changing the beneficiary form on a retirement account asset. I pick on a retirement account asset, and specifically I'm talking about a tax deferred asset, like an IRA account, a traditional IRA, or a 401k account. And they may want to provide a specific amount or a specific percentage, in this case, to the charity. Now, I know I talked against the percentage a moment ago, because that would be based on the entire size of the estate. Here, with the IRA account, if it's left as a percentage, it's a bit higher level of confidentiality, because the recipient organization only needs to see what was in that account in order to calculate the gift. But that is something that is really easy to do. You don't necessarily need a lawyer to do that. And you can update it as often as you like without expending any legal costs or anything like that. The reason I'm picking on IRA account assets is there's a twofold benefit. One is at death, when assets go to a charitable organization from a tax deferred IRA account, those assets avoid estate taxes. And just so you all know, Minnesota, there's Minnesota estate taxes and there's federal estate taxes. The Minnesota exclusion amount, that is the death tax, the inheritance tax, whatever you want to call it, the state of Minnesota now excludes the first $3 million of assets from a taxation on the total value of assets. And includable in the estate is IRA accounts. That sounds crazy. It's like you get taxed on that, on the value of the account, but then there's income taxes as well with IRA accounts. And so when an IRA, a tax deferred IRA account, goes on to charitable organizations, then we avoid income taxes as well as estate taxes. And just as long as we're talking a little bit about estate taxes, just to round off the information, there is a strategy for married couples to double the exclusion amount from 3 million to 6 million. And the federal exclusion amount is now this year, 24,120,000 for a married couple, or 12,060,000 for a single person. I'll say that again. The federal government excludes for a married couple the first 24,120,000, and then for a single person, the first $12,060,000. We won't get into the weeds. Those numbers are supposed to be cut in half, basically, when our law sunsets by January 1st, 2026. It will take an act of Congress to prevent the sunsetting of the law. I don't know about all of you, but I don't know if Congress could agree on the time of day if they're all looking at the same clock. So right now, the pundits who study these sorts of things believe that the sunset may well be real unless Congress can agree on an extension of the federal estate exclusion. Well, anyway, so if a person has some wealth and they're looking to lower the size of their estate, this gets back to the idea about the tiered approach. And maybe the assets that go to individual persons total the exclusion amounts for state or federal or whatever the case might be in a family situation. And then other assets go on to charities. You're getting a sense there's no right answer here. And it's a theme that Ron and Andrew and I, when we were talking about developing this seminar, we were talking about, I see somebody popped up in the chat. We were talking about the seminar and we were saying that, sorry, I got distracted by the chat. Shiny objects, what can I say? We were talking about encouraging people to make charitable gifts. And, you know, it's really carving out what is important to give to loved ones and family members, and then what can possibly be given to charitable organizations as well. Another idea in terms of charitable giving is the use of life insurance. And I know a number of my clients have had a charitable organization purchase a life insurance on their life. And they pay the annual premiums to the organization. They get a charitable deduction. So this would be like if I wanted to provide monies to JFS, as an example, I would have JFS purchase a policy of life insurance on my life. I know it sounds a little crazy. I would make a contribution every year to JFS that equates to the premium, and JFS will pay that premium amount for me. And then when I pass away, JFS receives the death benefit. So that's another strategy that people can use. Also, when we were preparing for this seminar, we were thinking, you know, there's really no one size that fits all. I think the thing that we all came up with is that by looking at each client's own situation and evaluating what might be right for them, and as advisors, Ron and Andrew and myself, all as advisors, and this is what advisors do, we present options to people and assist them in choosing what the best option is, because what's right for one person might be totally different for another person. The final thing I wanted to mention is a more sophisticated estate planning strategy. It's the use of CRATs and CRUTs. The tax code is replete with acronyms, 4-letter acronyms. A CRAT is a charitable remainder annuity trust, and a CRUT, you may have heard these words before, is a charitable remainder unit trust. The idea is that somebody with appreciated assets, say they have real estate, they bought real estate and maybe it was a vacation property and there's really no use for future family members that are interested in having that. Or maybe they bought stock, they bought 3M stock at $10 a share and now it's worth $100 a share. They set up this charitable vehicle at a charitable organization like the St. Paul Federation, and they transfer the asset into this trust, which is controlled by the organization. The organization sells that asset. Do they pay capital gains taxes? No, they pay no capital gains taxes, the organization, because they're charitable in nature. And so there's just, that's not the way the tax law works. There's no obligation to pay any capital gains taxes. The deduction is for the full amount of the value of the property less the return on the investment. And the IRS is replete with all sorts of tables about how this is calculated. But that gets to the difference between a charitable annuity trust and a charitable unit trust. And an annuity trust would say that the grantor, the person who has made this donation to the organization, is entitled to receive an income stream. And an annuity trust is based on a fixed percentage every year. I donate $100,000 to a charitable annuity trust at the St. Paul Federation, and I am entitled to receive a 5% return. Every year, like clockwork, I get $50,000. I get $5,000 back for my contribution. A charitable unit trust is just calculating the different return amount. So with a $100,000 donation, maybe my unit return is 5%. So the first year I get $5,000 back. The next year, that account has grown to $110,000. So I get $5,500 back. And then the next year, it looks suspiciously like 2022. The market has dropped. It's dropped to the value in my account has dropped to $90,000. And so I get $4,500 back. You see how that fluctuates. But that's the concept. It has to be the right situation. It has to be somebody who's looking to get out from under with a highly appreciated asset, whether it's real estate or whether it's a financial asset. And a final thing that I wanted to say about charitable giving is I think that charitable giving really rests on three things. And let me tell you a story, just a short story about that. I see some clients sometimes and they say, well, I don't want to pay any more money than I have to. I paid enough when I earned my money in taxes. I paid enough as my assets have appreciated in value. I don't want to pay any more that I have to. So charitable giving is certainly an option. But the conversation, in my view, ends if it's only about the tax deduction. Because many a time I've had clients, I pointed out to them, you can give money as a charity and save taxes. And one spouse looks at the other spouse and they shake their heads and they look back at me and they say, what charity should we invest in? So it's not that that's a non-starter, but the second thing about charitable giving is a charitable passion, having a passion around a particular organization. And that can be teased out. You can go, and I've done this before with clients. My clients didn't have really a clue as to their own passion, but through planners at the St. Paul Federation, we've worked through providing opportunities in the community, to presenting opportunities, and those opportunities would resonate, and somebody would get that charitable passion. So my point is, the charitable passion can be developed. It may not walk into our office immediately, but it certainly can be enhanced and nurtured and developed. And then the final thing is this notion about l'dor v'dor. I think that's the real fuel that fuels charitable giving. If somebody sees themselves as the ability to enhance further generations in our community, we may not know who those people are. We certainly won't know they are, but we have had a high appreciation from our community. We've benefited by being a part of the St. Paul Jewish community, and we want to extend that benefit to future generations in our community. With that, I think Ron and I have the next section about creativity with charitable gifts. Ron? I think you're on mute.
Well, we talked a little bit about a number of things that you can do, but really that kind of fits your individual passion. But what I have liked a lot that's really worked for me is the idea of really trying to involve your family into this program. And so, I would really encourage people to think a little bit about really sitting down as a family to decide what's really important to you. Because again, as Stuart had mentioned before, that really, there's no greater degree of satisfaction I think you personally can have than to really to see your children and your grandchildren take on some of their, not only the causes that you've been lent your heart to, but also some of their own passions that they brought to the table. And so I would really encourage you to go ahead and do that and try to, even at the risk of freeing up some of your own ownership and trying to get your children to really allow them to surface what's important to them. I think that's just a tremendous aspect to really establishing your own legacy from a personal basis. I've talked to Stuart a little bit about the whole area of, an ethical will. And Stuart has really given me a lot of insight and some information into that, and really the idea of being able to crystallize what's important to you, and not only from the whole area of tzedakah, but also just as far as really what are some of the values that you hold dear. And I would love for you to consider really establishing some of these types of values in writing, and helping to crystallize this for you as well as your family. I think that's something that I've kind of valued myself, and I'm excited about really bringing this to my clients' attention as well.
Great. Well, I have another story to share about creativity with charitable gifts. And this actually happened within the past month or so. I met with a client, and I think the client was a supporter of the JCRC. And the client was feeling that they don't have enough money to support the JCRC in terms of their estate plan. And they told me that they have always given for the past 40 years to, it used to be the ADL JCRC and now the JCRC. And now they're up to $10 a month. And they said, well, no one's going to want a gift for that. That's $120 a year. But what I did is I went through some math with them to say, you could make a donation to the JCRC's General Endowment Fund. And they usually have a spending policy about 4 or 5%. They look at their general endowment and they roll off each year 4 or 5% generally based on market conditions. And so what you do is you take your cumulative gift, your year gift, and you multiply it by 20. So if they're giving $10 a month, and there's 12 months in the year, the last time I looked, and that would be $120. So 20 times $120 is $2,400. They're not setting up a different endowment fund or anything like that. There's no minimums. It's just going to drop into the general endowment fund. And that's a great way then for that person to sustain their giving, sustain it over the years. The idea under economic theory is that with a 4 to 5% spending policy, it's probably going to stay up with the market conditions. So that $10 maybe $12 in the future or whatever it is. But that person could perpetuate their gift and really sustain who they are by supporting the organization. That person was so thrilled with that analysis that they wanted to raise it to $3,000. And so ever the negotiator, right? I'm a lawyer, hello, right? They settled on a gift of $3,600 to the JCRC, a nice round number. So it just goes to show that there's no gift that is too small. There's no gift that's too small, and charitable giving is easy and it can be flexible. That's one of the points we made tonight. You can always change your thinking by reviewing your estate plan. And this is, post-mortem gifts. These are after-death gifts. And charitable giving can really be an empowering experience. After our seminar this evening, I think on the website, and correct me if I'm wrong, Ellen and Dan are going to post a list of contact information at various Jewish organizations. And I really would commend you to reach out to your own attorney or your own advisor and see what's right for you. Behind me, if those of you that are so interested, is a picture of my father's store in Superior, Wisconsin. My father fixed shoes and also sold Red Wing work boots. And I learned many lessons in that store by working with my father at a young age, starting at about age 10. And when a person came in who was a worker, a laborer in Superior, my father used to ask, well, what kind of work they do? Because it's so important to match up the right boot for the right job. If you were a welder at the shipyard, you don't want anything with a lot of stitching on it. It won't last more than a day because all those hot sparks would eat away all the lacing and whatnot. If you worked at the grain elevators and it's wet and it's slippery, you need something with a good sole, right? And if you're a farmer, well, let's not go there, but the leather has to be tanned specially because there's a lot of methane and chemicals in the soil that can eat away at oil tanned leather. It had to be dry tanned leather. That was the lesson I drew from my father that really applies to charitable giving, that there's not one answer. I mentioned before, one size only fits one, and that's the truth. So I really commend you to take this issue up with your advisor and see what you can do to make yourself satisfied, as well as make the Jewish community even that much more stronger. So I'll turn it over to Don and Rhoda for some final comments, and then I think we'll take some questions. I think you're on mute.
Thanks so much, Ron and Andrew and Stuart. You've given us valuable information. As Rhoda said, we believe strongly in planned giving. We live in this wonderful community, and we want to do what we can to assure that these agencies we love and support will be here long after we're gone. Quickly, I'd like to share with you some of the things we have done. For one thing, we have established a philanthropic fund. You've heard it referred to as a donor advised fund. Each year, we make a contribution of stock, and we advise the Federation where we would like our gifts distributed each year. The gifts may vary from year to year, as explained, but we can make our gifts more regular. Secondly, I purchased long ago a second to die life insurance. You've heard about that. When Rhoda and I both die, the proceeds, the beneficiary will be the United Jewish Fund. Second to die life insurance has the advantage, premiums tend to be less because the insurance company doesn't have to pay off until two people die. Then I've established, you've heard about this, a charitable remainder unit trust. Years ago, I set this up. Each year, income is distributed to me, and when Rhoda and I die, we've indicated where we would like the proceeds distributed. And finally, I have an IRA, individual retirement account. I make gifts from the IRA each year, and again, the principal that's left at when I die will be distributed to agencies we've designated. These are 4 vehicles we've used that may be of interest to you. As Stuart said, one size does not fit all. These are things we have done. We hope you'll consider whatever it is, however you're able to do it, do consider planned or legacy giving. It's so important for our community. I thank you all for being here. Now I think I'll turn this over to Ellen for Q&A.
Sure, Stuart, we've started with some questions that are in the chat. The first one is about examples of third tier giving. What
Right.
that-
The shiny object, I apologize. Amy, I see you. I hope you're doing well, my friend Amy Sheldon. Amy, the third tier is very flexible. So after we provide for children and after we provide for charitable organizations, the assets can go really anywhere. It can go to additional charitable organizations, maybe not our first tier organizations, but it could go to additional ones. It could go back to our children, or maybe a class gift to grandchildren, or maybe a pro rata distribution among tiers 1 and 2. I had X amount going to the kids and Y amounts going to the charities. So whatever's left could be done on a pro rata basis. I think it's really something to kind of explore and give thought to, where you're at, and speak with your advisor about various options. In terms of the taxes, Amy, the state of Minnesota excludes $3 million for a single person. With a strategy for a married couple, it can be doubled to $6 million. That's the state of Minnesota. But wait, there's more. There's the federal government. And the federal government, that's that $12,060,000 for a single person, or $24,120. Say, by the way, those reasons, those numbers are really strange. They're adjusted for inflation every year. The new numbers were just released for federal. The state stays the same unless the legislature changes it. So by all accounts, it doesn't appear with our legislative composition that there's going to be a change in the estate tax exclusion for the state of Minnesota, given the recent election. But for the federal government, next year, the exclusion amount, I think it's $12,920,000, something like that. Just crazy. The federal government is out of the business taxing most people. And even if it's cut in half, even if it drops from, say, January 1st, 2026, say it's a $14 million exclusion for a single person, it still would drop down to 7 million. And for most people, they don't really have an estate approaching that amount. And if they do, you can circle back to any of your advisors, your accountant, your attorney, your financial advisor. They'll figure out a way to save taxes as well as fulfill your planning goals and desires.
I've got two additional questions if all of Amy's questions have been addressed. And then we can open up to people can just speak up as they think of things. First of all, Stuart, what are some considerations when deciding whether to list a charity as the beneficiary on a retirement account versus listing the trust as a beneficiary on a retirement account and including the charity as a beneficiary under the trust?
Got it. So let's say I have $100,000 in my IRA account, my tax deferred IRA account, and I'm fine with all of those monies going to my desired charitable organization or going at my death into a donor advised fund. That's fine. I can do that. No issues. But if I have a charitable component drafted into my trust or will or whatever my testamentary document is, that's the document that talks about, who gets what when you pass away. If it's drafted in that, then I would name the trust, if it's a revocable trust, as the beneficiary. I usually include language, though, alerting my trustee who's going to settle my estate to consider using tax deferred assets to fund the charitable gifts. And that can happen as well. There's been a relaxation of the required minimum distribution rules, and so we can certainly make that happen. Here's a Zen third way, Let's say I have $1 million in my IRA account, right? $1 million. I'm charitable, but not that charitable, right? And so what I would do is I would clone that account and put in $100,000 in that account. Then I could easily name my charities or my donor advised fund or any combination to receive those specific assets. And then my other assets in my $900,000 left in my IRA account, in this example, could go on to my other beneficiaries. The reason charitable IRA account assets is a real important consideration is in 2017, they changed the required minimum distribution rules, which were confusing enough. And now basically when it's left to children, they have 10 years to take the assets out of the account. And so that's 10 years, which could be of substantial income. There's not, it's not clear whether you have to take it out. It's not clear at this point in equal 10-year installments, or if you can wait to the last day of the 10th year. The IRS is still grappling with those regulations, so stay tuned. But as a general rule, if you're going to make charitable gifts, it's far better to use retirement account assets to fund those charitable gifts at death than any other type of asset.
Next question, what things should you consider when deciding between gifting appreciated stock to a charity versus making a qualified charitable distribution from your IRA to the charity?
Hell, this is where I would turn to Ron and Andrew. They are excellent advisors, and they could run an analysis for us. I know with your backgrounds in finance, and I suspect, and maybe you want to speak more to this, I suspect you would run the analysis and see how it works out better from a tax standpoint. Andrew or Ron, you want to weigh in on that?
Yeah, I'm happy to talk a little bit about it. I mean, it really depends on each situation on what makes more sense for the person. But one thing to think about is, do they itemize? Because when you donate long-term appreciated stock, yes, you don't have to pay the capital gains taxes on that. But then additionally, you get an income tax deduction on top of that if you itemize deductions. If you do not itemize and you're using the standard deduction, you don't get that additional tax benefit. Another thing is, what are your future gifting goals? Some people, if you have appreciated stock that you've held for a while and it's gone up, let's just say a stock's gone up $100,000. Once that person that owns the stock happens to pass away, then that stock, the cost basis will get stepped up, and then the heirs or beneficiaries won't have to pay capital gains taxes on that also. So there's a lot of different factors that go into it. And also it depends on the size of the capital gain. If your stock only has appreciated $1,000, then maybe that's not the best stock to be donating to an organization. It's really stocks that you should think about, stocks that have significant appreciation that you're donating. So there's a lot of different factors. Ron and I would kind of sit down and walk you through, if you do A, then this, if you do B, then this, and it would just come down to a calculation.
There usually is always an answer when you're doing tax calculations. That's one of the beauty of taxes, is that there is black and white answers as opposed to other areas of law where it's more gray areas.
Those are all the written questions that I've gotten. We can open it up to questions. We're blessed to have enough people that I can't see everybody on my screen. So please do speak up if you have a question for Stuart, Ron, or Andrew.
Looks like Elaine has a question.
And she's muted though.
I had one question that wasn't answered in chat.
Go ahead.
Sure.
It's
Can
in
you hear
chat
me?
for Stuart. Yeah,
It's- I saw the two questions, Amy, about the third tier and then about the 3 million exclusion and the 12 million.
yeah, you got, it's one more down with a red A.
Do you see it, Stuart, or you want me to read it?
Will you read it?
Yeah, just one second. Can you explain where the 20 comes from in the case of the person who started out with a
$10 a month.
Yeah.
$10 gift that
So-
bumped up to 600?
Right. So
It's a
20, the 20 comes, Amy, multiplying the 120, and that would provide a 5% return. So in other words, if I donated $2,400 to an organization, and that money, as part of their larger endowment fund, returned about 5%, then that 5% on $2,400 is 120, divided by 12 months is my $10 a month gift.
Okay. Okay. I see.
Okay.
Thank you.
You
Cover
bet.
that. Elaine, you had a question?
I don't have a question, but I wanted to be here and to honor Rhoda and Don. For they're an inspiration, as we all know. But I planned my estate years ago. So I just wanted to say I wanted to leave the legacy, and it's a good thing to do.
Thank you so much. Are there any other questions?
Yeah, I have a question. You know, one of the things I find burdensome, hard, and sometimes puzzling is if I want to give in a certain category, and then I go to say Charity Navigator, and I look for funds that are very efficient and that have CEOs that aren't taking a huge amount out of the donation. Sometimes I run into, it's not clear how to choose. You know, even if you do due diligence at a place like Charity Navigator, it's not always easy to assess the organization. Any thoughts about that? About how efficient the organization is going to be with your donation. And these sometimes are organizations that are not the closest to my heart, but I think they're a good thing to donate to. Anybody run into that problem or have some suggestions?
Amy, this is lots of suggestions. Amy, this is Ruth Olcott. I'm the CEO at JFS St. Paul, and I can just make a comment based on both running an organization and also as a donor. I mean, I think best practice in nonprofits, there's a recognition that you need to have good, solid infrastructure in order to be able to provide services. So organizations can tell you the percentage of the organization that goes towards what I call infrastructure. Sometimes people talk about the word admin or overhead.
Right.
That's kind of an older term, but all the things that make the organization run. And best practice is that you're somewhere in the 15 to 20% range. You can't starve your organization and be effective. So that's one thing you can ask. The other thing that I would say is try to figure out who might know someone within the organization and who could speak to that. And you've got a whole screen of people who know lots of people in the world of charities. So I bet if you call me, Amy, and ask me a question about an organization, I could probably get you connected to somebody who might know them.
These are
so
not,
that's what I would offer.
they're not necessarily local organizations. I've been looking at what, how high a percentage is given to the program. That's where I start. And I do look at admin. I haven't been as generous as 15 to 20%, but I want to know how much is going to the program.
Yeah, so you want to look for
with a reasonable administration, a reasonable fundraising.
So if I could interject, and Amy, it's a great question. So one of the things I would recommend is definitely do your homework, check Charity Navigator, check the Better Business Bureau, but I would also reach out to the agency itself and want to ask for an annual report or go online, look at the annual report, see how responsive they are to you. And I'm a CEO also of the St. Paul Federation, but I'm also a donor to a lot of organizations. And the Better Business Bureau has a guideline as well that administration overhead, whatever you want to call it, should not be more than 35%. And there has been a change in views over the last, I would say, 20 years, where nonprofits have starved their infrastructure. So they've been very, very careful of how much money they're spending on overhead and administration. At the same time, donors have become much more sophisticated and they've asked for return on investment, which means evaluating the programs, taking a look at best practices, and all those things which really make an organization professional. Doesn't go into programming, but it does go into improving the program. So I think that's something to take a look at as well. There are some really wonderful programs, but they don't necessarily do all the things that are necessary. They may not have an audit, for example. They may be all volunteer-led, which is not bad, but doesn't allow the professionalism that donors also are looking for. So I think it's a holistic approach. You wouldn't go to a doctor and say, who's the cheapest doctor or what's the cheapest hospital that I can go to? But you want to know which hospital is going to provide the best service.
Yeah, but Charity Navigator doesn't measure impact.
Yeah.
They're changing it. They've actually are going through a series. So before it used to be a 1 through 5 star rating. Now they're looking at impact, they're looking at their finances, they're looking at transparency, they're looking at succession planning. They're really taking a holistic approach and looking at the nonprofit sector, which I think will just strengthen the sector overall.
Yeah.
I'm happy to send you some information on that.
Great.
would
It's not
like
happening
to-
right now. It's in the future.
I would like to make a couple comments on sort of the philosophy behind working on this right now and on into the future. The discussion about engaging your children going back years and years. Our children knew we were engaged because one or the other of us was involved in some aspect of the Jewish community. And it seemed that that was always part of the discussion of what was going on over the dinner table. And so I think that they grew up knowing that that was something very important, and they grew up in this Jewish community. They went away and didn't come back, but I think that's a start, regardless of how young you are, or think that it's way too early to even be thinking about estate planning. But it's never too late to start talking about what you believe in and what is important to you. And the other thing is that we're talking about the St. Paul Federation, but we're talking about the synagogues and the other organizations and the family service and the JCRC and Alana's Rajman program. So that there are, in order for this community to thrive and continue into the future, and we certainly don't know what kind of new challenges we're going to have, we need to be all working together and helping to provide the wherewithal that the community will have as time goes on. So that's what I have to say right now.
Beautifully said. I want to be respectful of everybody's time. I think, Dan, you were going to close us out?
Yeah, I just want to, unless there were other questions, but I just wanted to thank everybody for being here. Thank you, Don and Rhoda. Thank you, Stuart, Ron, and Andrew for sharing your expertise with us. And just to let everybody know, we will be sending out the agenda, the video from tonight, as well as a list of contacts in the Jewish community that you can have these discussions with each organization. And again, this is a step in the direction to continue supporting this need in our community, and expect to hear more from our federation about how we are collaborating and providing a resource for the whole community around planned giving. And so we're grateful for all of your involvement, and thank you for ensuring the lasting presence of a vibrant and inclusive Jewish community in St. Paul.
Thank you.
Thank you.
everyone.
Thanks, Dan.
Thank you all.
Thank you
Good
all.
night, everybody. Thanks, Ron and Don and Rhoda.
Wonderful job.
Thank you.
Good night, everybody.
Good night.
Good night.